Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's Hot Sheet, I will discuss what could happen to the housing market if the U.S. defaults on its debt, home price predictions, new homes, and the risk of hard economic landing. Today is Friday, May the 12th, 2023. I am Byron Lazine, and the Hot Sheet starts now. All right, finishing off the week strong here on this Friday. Hit the thumbs up if you're watching the live or the replay on YouTube. And I've been getting a whole bunch of DMs. I'm not one of the people that like screenshots people's DMs and then puts them into my Instagram stories. I think that's a little bit cringe. But I want to just thank everybody for saying how much the Hot Sheet has meant to them in their day-to-day, how much they appreciate it. So thank you for all the DMs that I have received. And if you are somebody who listens to the replay, because I've gotten a lot of those DMs, and you're listening on Spotify or Apple to the replay, please consider giving the Hot Sheet a review. It would mean a lot to me, just like on YouTube. The thumbs up means a lot for the show. So appreciate that, and thank you. Let's jump into topic number one. Zillow, according to Zillow, says that the U.S. default, if the U.S. defaults on its sovereign debt, which Janet Yellen says could happen as early as June 1st, which is only a few weeks away, a U.S. default would see mortgage rates top 8%, home sales would then plummet, and the housing market would slip back into a deep freeze. Okay, the highest that the mortgage rates got in quarter four of 2022, of course, were 7.37. A U.S. default would mean they would top 8%. I think Zillow's being a little bit conservative there. I think if the U.S. defaults on its debt for an extended period of time, you would see mortgage rates go into the double digits. That's just a personal prediction. But let's take a look, according to Zillow and written by Fortune, what this Zillow chief economist, Jeff Tucker, says. Janet Yellen obviously said if we do default, and it could happen as June 1st, the economic calamity would ensue, and what that means for housing, according to Jeff Tucker, Zillow's chief economist, says we would top these 8% rates. He also says that if that were to happen, you would see home prices plummet 23%. Now, he goes on to say what I think all of us believe to be true, that U.S. defaulting on its debt is extremely unlikely. And so in the unlikely scenario that the U.S. decides to either, not raise the debt ceiling, which is basically Democrats want to raise the debt ceiling, Republicans want cuts in the budget. Okay, so those are the two, options to kind of, move past this debt default. Obviously, they'll probably wait till the last minute. If they do that, Jamie Dimon on CNBC yesterday, the CEO for JP Morgan Chase, he says the closer they wait, the more panic will overtake the markets. And so you could see some deals in the markets, if they wait a week or days before the debt default deadline, he believes there will be panic in the markets. Okay. They'll probably wait till the last minute. This is what they do. They're not really good at getting things done ahead of deadline. There'll be some negotiating. They'll probably meet in the middle or, somewhere in the middle. We'll probably end up raising the debt ceiling. I think ultimately Republicans will cave, and the easiest option is to raise the debt ceiling, kick the can down the road. I'm not advocating for that. I think we're spending way too much money. I'm just saying that that's the likely scenario if I had to bet on it, if I was going to Vegas and betting. But that's what it would take us to say, okay, we can't come to an agreement in Washington. We're going to default on our sovereign debt. We're going to take a major hit to the U.S. dollar. That's what it would take, according to Jeff Tucker from Zillow, for home prices to drop 23%. It would take the U.S. defaulting on their debt for home prices to drop 20% plus nationally. So for everybody saying to your home shop, every Uncle Bud in the ear of your home shopper saying, hey, just wait, home prices are coming down 20%. Tell that home shopper, tell that buyer that you're working with to go back to Uncle Bud and say, oh, so you believe the U.S. is going to default on their debt? Because that's what it would take for home prices to drop 20%, 23%, according to Zillow. Now, let's just play make-believe land here for a second. Bear with me. And what the difference between the 6%, which I think is where most home shoppers, let me know where your home shoppers are getting locked into this week. It's been about 6.5%, but a lot of strong buyers can get locked in even closer to 6%, depending on where they are locally, depending on the lender they work with, depending all of that. I'm not a mortgage lender, but let's just take a look at 6% versus 8% in make-believe land. If you're putting down 20% on a $600,000 home, putting down 20%, the monthly payment at 6% would be roughly $2,878. That's without taxes and insurance. Okay, $2,878. With the exact circumstances at an 8% mortgage loan. Okay, this is 30-year fixed, 20% down. The monthly payment will be $3,522. That's basically a $650 difference on a $600,000 home when looking at 8% mortgage rates and 6% mortgage rates. When rates hit 7% for a short period of time in quarter four, we saw how buyers receded from the market. Quarter four for a lot of real estate agents seems to be in the rear view mirror. I don't hear a lot of agents talking about, geez, do you remember when homes sat on the market a whole 2 weeks without having multiple offers? That was quarter four of 2022. All of a sudden now it's like, wow, 20 offers, 30 offers. Had an agent on my team in Connecticut, had 89 offers in a home. Let me know this year what's the most offers you received on a home in the comments, right? That's what we're experiencing now. We're having a short memory. Rates jump back up over 7. Rates get to 8% in this scenario, outlined by Jeff Tucker from Zillow. Then you will see buyers recede out of the market. You will see even more sellers clam up than you've seen in this spring market. And you will see not only a deep freeze, but what I've referenced from going back to last year, a complete Cold War where people are doing nothing. When we forecast the evolution of the housing market over the next 18 months, in the event of such a debt default, okay, so now Zillow's playing make-believe land 18 months out. We estimate that existing home sales would fall as much as the 23% that I mentioned relative to no default baseline forecast for this year, and that home sales may be 5% lower at the end of 2024 than expected in a no default scenario. Okay, so according to Zillow, the existing home sales would go down to 3.3 million. The annual existing home sale rate would go down to 3.3 million in September. We're projected to have 4.4 million. That would be the lowest in the last 20 years for sure. 3.3 million home sales. That would beat any of those recovery years in 08, 09, 10, so on. All right. What should we expect from the housing market in not make-believe land? Let's switch over to reality here. Okay, so here are some housing predictions grouped together. Lance Lambert did a great piece on this. So we can look at, because listen, I think we're all in the same camp. A debt default, if the government puts us in that position, that would be completely insane. And, we should fire everybody on both sides of the aisle if that happens. So heading into 2023, most analysts were bearish. Among the 27 major forecasters, if we're going back to pre-2023, 23 of the 27 expected national home prices to fall in 2023 because of what we saw with mortgage rates in quarter four. However, that hasn't manifested. Okay, we know that in February and in March, multiple forecasters are saying prices have bottomed, and they're showing the data to support that nationally. Okay, we've covered that a whole bunch on these streams. So after declining for 7 straight months, and this is according to the gold standard Case-Shiller, which we don't have Case-Shiller's numbers for March yet, but we do have Case-Shiller's numbers. I apologize. I'll get this chart up here. It'll be in the daily download, as all of our charts and sources always are in the daily download below. But Case-Shiller, typically considered the gold standard for housing prices, they had us finally in February nationally bottoming out and home prices going up for the month of February. Okay, so if you remember here, I can get this chart up now. There it is. We had according to Case-Shiller, we had 6 straight months of home price declines: July, August, September, October, November, and January. And then February saw a 0.2% increase. Case-Shiller's March numbers will be out soon. And there's your table there showing you that the gold standard, Case-Shiller, has shown that home prices have bottomed. We've gone through a whole bunch on recent streams that have shown us, Black Knight and, Fannie and Freddie and FHFA and many others have shown us that not only February prices have started to go up, but also in March and some early signals for April that home prices now month over month are going up. Okay. So what do forecasters believe now? If 23 of 27 of them before the year believe that home prices were going to go down, having this data of the first 4 months of the year, where do they believe we are now heading? Let's take a look. CoreLogic, one of those, forecasters who have shown us that home prices have bottomed and expect them to go up. Well, this U.S. Real estate research firm expects that home prices will rise 4.6% between March 2023 and March 2024. Okay. All of this data is going to be down below for you in the daily download, this source. So if you want to use it, or if you're taking notes for the weekend or for your newsletter before home shoppers go out this weekend, CoreLogic, 4.6% between March 2023 and March 2024. Okay. Zillow, not the debt default scenario. This is, again, taking debt default out of the equation. Zillow economists expect that prices will rise 1.7% between March 23 and March 24. So CoreLogic's at 4.6, very bullish. Zillow's at 1.7. Bank of America, they say that home prices will shift 0% in 2023. So they're projecting home prices will stay flat, not down anymore. Mortgage Banker Association, the trade group's latest forecast, has home prices falling 0.6% this year, and they're calling for another 1.4% dip in 2024. Mortgage Banker Association had us at lower prices. They do expect 2.1% rise in 2025, but that's way out there. So this year they're at 0.6% to the negative. Mortgage Banker Association was much lower than that to start the year, and they're typically, especially in these times with high mortgage rates, going to be more conservative than everybody else. They're going to be more bearish than everybody else because they're licking their wounds on the mortgage rates. They think everything is driven by the mortgage rate. We know that there are, a lot of cash buyers out there. In fact, there are 3 out of 10 purchases are cash. So another stat for you there, that 3 out of 10 homes are purchasing cash. I don't think Mortgage Banker Association is taking that into consideration when they look at their home price projections. Fannie Mae, okay. Fannie Mae now projects, their updated says that we will fall 1.2% in 2023, even though they are showing us home month over month increase. They're also calling for another 2.2% dip in 2024. Morgan Stanley expects home prices to fall 4% in 2023. Moody's expects home prices to fall 4.4% between the fourth quarter of last fourth quarter and the fourth quarter of this year. Okay. Goldman Sachs, they're calling for a 6% total fall in 2023. And KPMG, the Big Four accounting firm, expects that prices will fall 8%. Listen, I'm in the camp that home prices are going to continue to go up throughout the spring. We've seen that bottoming out, but I do believe home prices will start to drop again at the end of this year. I can see and talk to agents a lot throughout the days, every single day, right? And I hear a lot of agents that are turning showings down right now because they're so busy sifting through all their offers on their listings. It's a really bad move. This November will be worse than last November and December. I think 2024 overall is going to be better than 2023. So if you've got the savings to kind of wait it out until spring 2024, bravo to you. You've done a good job, getting prepared for what's to come. But what we're experiencing right now and over the next 2-3 months is going to be a total 180 from what we're going to experience in Q4. Just saying, just warning for the agents that are turning showings down right now that are too busy to put in the work while it's available. It's not always going to be available in 2023. I can promise you that. Okay, so let's take a look at, and I've got more on more data on that in the fourth and final topic. But first, let's go to topic number 3, current state of the housing market according to calculatedriskblog.com. They're saying that new home inventory is at a record percentage of total inventory. So new construction, brand new homes is a record percentage of our total inventory, which we know is almost at an all-time low, not the all-time low of last year, but another complete low for total inventory. Okay, so total inventory for new homes is now over 25% of total inventory. Here's a chart here to show you this, going all the way back to 1994. This beats the run up of 2004, 2005, 2006. That new construction, new homes is making up of a total percentage of inventory, up over 25%. This is not good. Okay, this is not, oh, great, we're building more homes. No, nobody's listing their existing homes. That's why this number is so high. And we know new homes are overall, I know there are some markets where you've got affordable new construction, but most of America, new homes are not affordable. The median price is upwards of $450,000. The average price for new homes, for new construction, is over $550,000. This doesn't meet affordable housing in America. So new homes making up over 25, almost 27% of total inventory at an average price of $550,000 is not good for home shoppers. That's why we're seeing people with 89 offers on a listing, 20 offers, 30 offers on a listing, because anytime somebody gets a $349,000 listing, the buyers swarm, cash and mortgage included, and it just drives price up, and you have multiple offers because you've got very little affordable good inventory. So I look at this chart and I shake my head. This isn't good. We talked about it yesterday. If you missed yesterday's hot sheet, we talked about how we need stimulus in the top, some type of way to create affordable inventory. Take the regulation out of the builders, but say, I'm only taking the regulation out if you produce product sub 400,000, sub 350,000, depending on the geographical location, of course. Okay, that chart will be down below for you in the daily download. New homes are now making up over 25% of total inventory. Okay, so with the debt default, with the job market, and we updated jobs here this week. We're going to talk about jobs a little bit right now. With all of that, is a soft landing possible, or are we headed for an economic hard landing? I'd like to play a video off of CNBC, Haley, if you could play that now, and then I'll react to it.
What determines whether or not we go into a hard landing is actually not about housing. It's really more about employment. And if we see deteriorating employment, what we always see is that housing bounce, which today I would argue it's a bounce, not a bottom, rolls back over as people lose jobs.
And so that's why this employment report jobs claims is really so important.
So Michael Cantro of Piper Sandler, he's following jobs more than he's following anything else to tell us if we are going to be going into a hard landing economically. That there are some that say, hey, housing is going to pull us into a recession and then help pull us out right? We've talked about that on the stream. I've been saying what he's saying for months now. I'm watching jobs closely. You heard me say probably a lot over the last month and a half that as the job market has started to, loosen up a little bit, started to normalize a little bit, that the Fed likes that. They said last year we want to put housing in a recession. They did that. They were able to do that with where mortgage rates went. And then they've said, well, we can't have a job market get out of control. Okay. The Fed wants to break housing. That's Logan Motoshami's big quote from Housing Wire on CNBC. The Fed will not be satisfied until they break jobs, till they break the employment market, right? The labor market. Reason why is it makes their job easier to fight inflation. Okay. But and you might say, okay, well, interest rates are going to come down. So if the job market loosens up, that'll be good for real estate. People lose jobs, not good for housing. So I'm with Cantro here from Piper Sandler when he says, I don't think that's going to be good for housing if more people are losing their jobs. Okay. What happens then is people start to make survival decisions. Okay. Maybe I'm going to go, move in with family and friends, right? You start to see everybody tighten up. Of course, just as a reminder, we did have U.S. jobless claims rise to the highest level since October 2021. We're still near an all-time low on unemployment, but we're starting to see it loosen up. We had recently 11 million job openings a month, 2 months ago. We got under 10 million. There's belief that we could get to 7 million job openings. And the job opening thing is a little crazy. We interview all the time, and I talk to team leaders who are interviewing all the time and brokers who are interviewing all the time. And you get some odd applicants. Like, I just got to say, there's something weird going on where people will be like, well, I know this is a full-time position, but can I work 20 hours? Or I know this is an in-office position, but I'd really want a hybrid schedule, or I'm not taking the job, or they just don't show up for the interview. That's the other one. So it's a weird job market, a lot of openings, a lot of people applying. And then there's kind of a disconnect there at times. And now we're seeing unemployment rise, and we're certainly seeing it with the big companies. We haven't seen it with the smaller companies as of yet, but overall jobs data is normalizing. This is from Housing Wire. Average hourly earnings year over year. You do see the increases in hourly earnings starting to dissipate or start to lower. So that would be good for inflation. We can see that here in this chart again. Wage growth is continuing to cool. I didn't put these charts down below, but I did put the other two charts, the housing charts that we reference here. You can see that job openings data is down below the 1 million mark. And there's belief that we could get that down to 7 million as we normalize this job market. Okay. I'd continue to watch jobs. I believe that could be a huge impact on real estate if we do break the job or labor market like the Fed is potentially looking to do. Haley, I'm going to bring up the 10-year and the 30-year, see where we're at on that. If there's any questions, I've got a little bit of time left before we sign off. I could. Okay, so the Pisano Group living in Boston. Why will this fourth quarter, and this is my opinion to be clear, okay, most of the stuff we talk about on here is data and sources and all of that, but this is my opinion, fourth quarter will be worse than last year in terms of real estate agents. When I say that, I'm talking real estate agents' ability to close transactions, to get contracts to get deals under contract into escrow. I do believe that we're going to see interest rates potentially lower than they are today. Why do I believe that? Because I believe we're going into a recession. And typically in recession, you do see mortgage interest rate come down. So I believe we're going into a recession. I believe the job market is going to get harder for people. And going back to what I just mentioned, I think if more people lose jobs, less people are going to be thinking about real estate transactions, whether it be from an investment, a buy, or a sell side. I believe that the sellers, we're in a extremely low inventory situation right now. And I believe the sellers who want to sell in 2023 are taking advantage of this opportunity now in the peak selling season. This is peak selling season. If you're a seller in 2023, you're selling for a reason. And why the heck would that reason be around the holidays in November and December? Okay. It'll be even worse if interest rates stay where they are and don't get into the fives like I think they will. It'll be even worse. And what is an interest rate in the five going to do? Just bring more buyers out of the woodwork? I don't think we're going to have a lot of sellers unless interest rates got down to 5, where people can say, all right, I'm going to go now buy the next house because I'm at 3.5%, but 5's not that far off. I'll go buy the next house and put my house on the market. Where's the inventory coming? Where's the affordable inventory coming? We're still going to have an inventory crisis in the fourth quarter of the year. I think we're going to be in a worse economic situation in the fourth quarter, third quarter. We're going to be in a true recession. And I just believe that similar to last year, you're not going to see a lot of movement. This is peak movement season. So we're all of a sudden getting used to high showing time, showing us, 50 showings on a listing that goes live in 24 hours. Won't be the case in the fourth quarter, just my predictions on the market. And if you remember fourth quarter of last year, that was the case. You will have a harder seasonality dip than you typically do this fourth quarter as we go into a potential recession. All right. Any other questions? Love to take them. We do have a dip in the 10-year, which is good. So overall, the markets aren't going crazy about the debt default yet. Jamie Dimon says that they will go crazy towards the end of the month if we get closer to that without an agreement. Hopefully we can just get to some type of an agreement in Washington. That would be fantastic. Yesterday's 30-year fixed here did drop under 6.5 with the 10-year drop. We were at 6.49. So if we can hold strong on the 10-year today, hopefully we will see another drop and stay sub 6.5% on the Mortgage News Daily 30-year fixed daily survey. Of course, in your market, you may be able to get a buyer. And if there's a lender in here, feel free to leave a comment on the replay or here in the live chat. I don't know where you're locking people in, but I'm hearing 6.25 a lot. I'm hearing, low 6s with really strong credit, right? And there's always opportunities to buy down and all of that. Today, we've got a Knowledge Brokers podcast, myself, Lisa Chinati, and Tom Toole over on that YouTube channel at Knowledge Brokers Podcast. So we're going to go deep on all of the week's happenings. So if you're interested, please go and check that out. And if you haven't done it already, please check out the link below for BAMX. It's your real estate marketplace for business, marketing, and social media. Everybody tells you what to do. BAMX is going to actually show you how to do it. We've got a ton of courses uploaded already and more coming. There's BAMX member courses like the Ultimate Instagram course for real estate agents, objection handling from Tom Toole. There is scroll stopping captions. There's a lead pillar course coming next month from myself. That's all included in the BAMX membership, which is about, if you sign up annually, about the cost of a cup of coffee per month. We also have live streams in BAMX, and then we have creator courses, and you get a 25% discount on all creator courses when you're a BAMX member. Canva 101, Mastering Canva Design from the guru herself, Haley from Coffee and Contracts, did that course. We have Attract Clients with video content as well with Tom's story. Go check out BAMX. It is by far the best marketplace ever invented in real estate. And we have a community, so check that out with the link down below. Thank you for tuning in this week to the Hot Sheet. I really, really, truly appreciate it. If you typically view the Hot Sheet here on YouTube, I'd love for you to subscribe to the channel. And if you are listening on Spotify and or Apple, it would mean the world to us if you'd consider leaving the podcast a review. Thank you very much. We'll see you on Monday, live at 9:30 a.m. Eastern, 6:30 Pacific time. And until then, have a great weekend. And of course, toodaloo.